Welcome to This Explainer. Today, we're unpacking a really fascinating and heavily debated interview that recently popped up on Quillette. It's a deep dive conversation with veteran asset manager Geoff Wilson, all about Australia's proposed capital gains tax changes. Now, regardless of where you sit politically, this is just an incredible case study in economics. We're going to explore how a single policy shift can create these massive, sometimes totally unintended behavioral ripples across a whole nation. We're talking impacts on everyone from a 20-something trying to buy their first home, all the way up to a tech CEO trying to recruit top talent.
Right off the bat, let's jump into Wilson's most intense claim here to set the stage. He says, I call it economic vandalism. They're putting Australia back 300 years. I mean, wow, that is a huge claim, right? He isn't just saying this is a minor tweak to the tax code. He's arguing that these specific changes are a severe generational threat to the country's prosperity. So we have to ask, how does a seasoned asset manager arrive at that kind of apocalyptic conclusion over a tax reform?
To make sense of this highly technical subject without taking sides, here is our roadmap for today. We'll cover 1. The fixed pie economy, 2. Unpacking the tax catalyst, 3. The young investor impact, 4. Changing corporate behavior, 5. The brain drain threat, and finally 6. A historical warning.
Okay, let's start with Section 1, the fixed pie economy. So Wilson argues that this entire debate doesn't just come from a sudden need to raise government revenue. It actually stems from a major philosophical shift in how lawmakers view wealth creation. Think of the economy like a giant bakery. For the last 50 years, the norm in Australia was all about aspiration and productivity, basically baking a bigger pie so that everyone gets a larger slice. But Wilson suggests the government has shifted to a fixed pie mentality. This worldview assumes the bakery is out of flour. The pie is static, it's not getting any bigger. And if the wealth is static, policy becomes laser-focused on distribution. The only way to give someone a bigger slice is to physically take it from someone else. He argues this ideological shift is the root cause of the new tax approach.
Moving on to Section 2, unpacking the tax catalyst. So what is the actual policy triggering this critique? Well, it's the proposed capital gains tax, or CGT, changes. It's a broad tax increase that punishes the indexation method. Now, a lot of people initially assumed this was just a tax on housing to cool down real estate, but Wilson points out it actually applies to all capital gains, including riskier business investments and startups. And regarding indexation, in simple terms, indexation used to protect investors from inflation. It basically meant you weren't taxed on fake profits that just happened because the general cost of living went up. Under the new proposal, that protection is heavily penalized. Critics are warning this will effectively give Australia the highest CGT in the developed world. Now, check out this number because it's honestly kind of hard to believe. 7.7 million. That is the number of everyday Australians who own shares directly, outside of their superannuation, which is basically their mandatory retirement account. According to Wilson's analysis, Treasury modeling allegedly completely missed the scale of this group. They apparently based their estimates on the incredibly bizarre assumption that these 7.7 million people only owned one single share each. I mean, if only the stock market worked like that, right? Wilson argues this massive miscalculation completely hides how hard this tax will hit everyday citizens just trying to build a little bit of wealth.
All right, Section 3, the young investor impact.
Let's look at our first major behavioral ripple, focusing on young people trying to get ahead. If you're in your 20s or 30s, you know exactly how brutal the housing market is. A lot of young people rely on passively investing in ETFs bit by bit on their phones, hoping to scrape together a house deposit. Well, according to Wilson's calculations, because this new policy effectively doubles the tax on capital gains in real terms, it drastically slows down compounding interest. So a young person doing everything right, saving diligently, investing passively, is now going to need nearly 4 extra years to save up for that exact same house deposit. But it actually goes deeper than just losing time. Look at how the incentives flip here. Under the old system, patience paid off. It rewarded holding assets long-term. But look at the new incentive. If a young person holds an asset long-term now, they face a minimum 30% hit on those gains. But if they act like a day trader, constantly buying and selling, that money gets classed as regular income. And for a young worker in a lower tax bracket, their income tax rate is actually lower than that 30% penalty. Wilson points out that this tax actively discourages patient saving and perversely incentivizes young people to become short-term traders, basically gamblers, just to avoid the penalty.
Which brings us to Section 4, changing corporate behavior.
So this second-order ripple effect doesn't just hit everyday investors. It fundamentally alters how businesses operate. Under the new rules, if a company keeps its earnings to grow the business, its value goes up. But when an investor eventually sells their shares, boom, they get hit with that massive new capital gains tax. So mathematically, it actually becomes advantageous for companies to just pay out 100% of their earnings right away as fully franked dividends. And for those outside Australia, a franked dividend just means the company already paid tax on it, so the investor gets a tax credit. It's super attractive for the investor, but it totally drains the company's bank account.
And that creates this nasty corporate doom loop. Step 1, higher tax on growth. Step 2, companies respond by paying out 100% in dividends to protect their investors. Step 3, because all that cash is literally walking out the front door, there's zero reinvestment. No new research, software doesn't get updated, they don't hire new staff. Which brings us directly to step 4, stagnant national productivity. Critics argue this cycle essentially strangles a business's ability to scale up and innovate. Section 5. The brain drain threat. This lack of local reinvestment naturally leads us to a third ripple, and this one hits the international stage. Wilson shared this anecdote that really stuck with me. He talked about an Aussie startup founder trying to recruit brilliant top-tier talent from Singapore. Originally, the founder was going to offer a good salary plus 5% equity in the company. But when these tax changes were announced, the tax burden on that equity got so heavy that the founder had to literally double the offer to 10% just to make it worth the recruit's time. And you obviously can't just keep doubling everyone's equity forever. There's only 100% of a company to go around. When equity loses its value like that, the dominoes fall fast. Skilled immigrants look elsewhere. Local startups realize it's just easier to relocate to the US or Singapore. The cost of capital shoots up, and you get this devastating loss of local ambition. It's a dynamic that threatens to isolate the nation, causing a severe brain drain as entrepreneurs just pack up for more competitive global markets. Finally, Section 6, a historical warning. To really grasp the long-term stakes here, Wilson draws a pretty chilling parallel to the UK. Back in the 1970s, the UK had this effective 98% tax rate that caused a famous brain drain. But the more direct comparison is in 1999, when the UK removed their advanced corporation tax. Without getting into the boring tax code details, it was basically a system that rewarded locals for investing in local companies. When they killed that incentive, the fallout was absolutely staggering. UK ownership of UK companies completely collapsed from 40% down to just 6% in the 2000s. Wilson is warning that when you implement anti-growth policies and strip away local investment incentives, it breaks an economy so deeply that it can take generations to recover.
So as we wrap up this explainer, we're left staring at this massive tightrope. How does a nation balance the immediate need to raise tax revenue with the absolutely essential drive for economic aspiration? It is an incredibly tricky balance. If you tax too little, critical public services are going to suffer. But, as we've seen in this critique of the capital gains tax, if you tax the mechanisms of growth too heavily, you might just inadvertently rewrite the behavior of an entire generation, stalling out the very productivity that creates wealth in the first place. Thanks for hanging out with us for this deep dive, and keep questioning the ripples beneath the surface of our policies.